They told you it was just a correction, a technical adjustment, a normal part of the cycle. But what if it wasn't? What if every time gold or silver spikes, someone somewhere pulls a hidden lever? What if the system doesn't just respond to volatility, but is engineered to survive it at your expense? Why do prices crash right after momentum builds? Why do margin calls arrive after the breakout? Why do paper markets collapse while physical demand stays on fire? This isn't about manipulation. It's about something far more structural and far more dangerous. And by the time the headlines explain it, it's already too late, because the next move isn't about price, it's about power. And who loses it? When the system resets. Stay with us. The real story begins now. Welcome to CSC Alert, where we decode the financial moves before they hit your portfolio. If you're over 50, you've already lived through a few storms. But trust us, this one's different. If you value what you've built and want to protect it through the chaos ahead, hit that red subscribe button gently, like you're locking a safe. Also, let us know in the comments, where in the world are you watching from? Understanding markets always starts with knowing where you stand. Let's begin. They had seen the price climb. Silver was moving fast. Gold followed with strength. Everyone was watching the charts. But then it happened again, just like before. The exchange raised margin requirements. Within hours, the market flipped. Excitement turned into panic. Prices dropped sharply. And online forums lit up with the same old accusations. They're doing it again. It's a setup. They don't want us to win. But very few ask the deeper question. What exactly is a margin increase? And why does it happen in the first place? He was a small trader operating from his home office. He believed in silver. He believed it was undervalued. But he didn't understand the system. He used leverage because it gave him bigger exposure for less cash. And for a while it worked, until the margin changed. The phone call from his broker was short. Either add more funds, or your position will be closed. He didn't have the cash. And within minutes, he was out. She was a risk officer at a clearing firm. She wasn't thinking about silver's long-term value. She was thinking about exposure, liability, and system failure. Her job was simple: keep the house from burning down. When volatility spiked, her system sent a signal: raise margins. Now, and they did. That's the unseen world of margin mechanics. It's not personal, it's structural. Futures markets work differently than most people think. They're not built for buying and selling metal directly. They are built to manage risk. Miners use them to lock in prices months ahead. Refiners use them to plan production. Industrial buyers hedge their future costs. Speculators come in to bet on price moves and to provide liquidity. But all of them operate under one key rule: you can control a large position by only putting down a small amount of money. That small amount is called margin. It's like putting 10% down on a house. You don't own it completely, but you get full exposure to its value swings. And that's fine when markets are calm. But when prices move too fast, especially in thin trading periods like holidays, the system begins to stretch. And when the system stretches too far, risk increases for everyone. This is when the exchanges step in. They don't care if prices go up or down. They care whether trades will settle and if obligations will be met. To protect the system, they raise the margin requirements. That means traders need to put up more money to hold the same position. And if they don't, they get liquidated. It's a forced sale, not because they changed their mind, but because they couldn't afford to stay in the game. This is the point most people miss. They see the price drop. They blame manipulation. They say someone pulled the plug. But in reality, it's often just a chain reaction of forced exits, set off by structural rules, not emotional decisions. Futures commission merchants, FCMs, are the first line of defense. These firms clear trades on behalf of clients. They see client risk in real time. And long before the exchange acts, they raise margins internally. So margin hikes often hit traders before the public even hears about them. By the time the official margin increase is announced, the first wave of liquidations has already happened. He didn't know that. He saw the price drop and thought it was an attack. But the truth was simpler and more dangerous. It was math. The system doesn't care about hope, belief, or long-term faith in metal. It responds to volatility, and volatility doesn't care who's holding what. When the models say risk is too high, they trigger a new margin level. It doesn't matter if the price is rising or falling. Only the speed and size of the move matters. A 30% move in 6 months is tolerable. A 30% move in 2 weeks? That's a fire. To stop the fire from spreading, margins go up. This creates the illusion that the system is crashing the market. But in reality, it's trying to survive it. She saw it from inside the clearing firm. The data was clear. Some traders were using 20x leverage on silver contracts. If the price dropped even 5%, they'd be wiped out. So she raised the internal margin because if they couldn't pay, her firm would be left holding the loss. And that's the deeper truth. When people talk about the system, they often picture some villain in a suit pulling levers, but more often than not, it's just layers of institutions protecting themselves from collapse. Margin is not manipulation, it's survival. The structure doesn't punish belief, it punishes overexposure. Those who understand that stay in the game longer. Those who don't get washed out every cycle. And that's just the beginning. Because what happens after the margin hike, how the price reacts, who survives the flush, and what demand remains, tells a much bigger story. A story about real demand versus leveraged dreams. He had seen the headlines before. Silver slammed after margin hike. Gold tumbles as traders exit positions. But this time, he paid closer attention. He had just watched silver jump 18% in 5 days. Momentum was building. Retail traders were flooding in. Technical indicators were flashing green. And then, just like that, the momentum collapsed. The price didn't just pull back, it fell violently, as if someone had pulled a lever, as if the market had been pushed off a ledge. To most observers, it looked like manipulation. But underneath the surface, something else was happening, something mechanical. It began with one simple change. The margin requirement had been increased, not by much, just enough to trigger the system. The change forced every trader with high leverage to make a decision: fund the account or exit the position. For many, there was no decision to make. They didn't have the capital to continue, so they were forced out. And that's where the cascade began. He wasn't the only one. Thousands of positions were unwound, not because of a change in conviction, but because of a change in cost. She had seen it from the institutional side. The firm she worked for managed commodity exposure for multiple clients. They weren't speculators. They were producers, hedging output. They had deep capital and long timelines. When the margin hike came, nothing changed for them. They met the new requirements easily. They didn't sell. They weren't forced to. And that's the divide. The same event, a margin increase, creates two entirely different outcomes, depending on who you are and how you're positioned. Retail traders using maximum leverage feel like they've been targeted. Institutional players with structured risk plans continue unaffected. But from the outside, it all looks the same. A big price drop. The public sees the chart. The candles are red. Volume spikes. And the narrative forms instantly. Someone's crashing the market. But most of the time, the market is crashing itself. Not because of new sellers, but because of forced liquidations. It's not discretionary selling. It's mathematical. Accounts hit margin limits. Positions get closed. Sometimes, even profitable trades are liquidated to cover losses elsewhere. And just like that, supply overwhelms demand temporarily. This creates a false signal, a mirage, because it looks like the trend has ended. But in reality, the trend hasn't changed. Only the participants have. She had seen it in silver before, a parabolic move followed by a sharp flush. Social media would scream manipulation. But when she reviewed the data, the story was clear. It was over-leveraged money exiting in panic. And the institutions? They bought the dip. They always did. Because they understood something most retail participants missed. Margin hikes create distortion, but not direction. The difference is critical. Distortion is short-term. It's like a camera lens shaken by a tremor. You can't see clearly, but the object hasn't moved. Direction is long-term. It tells you where the market is headed over months or years. Margin hikes affect distortion, not direction. But for traders watching daily charts, the difference gets blurred. He remembered one specific event, a 15% drop in gold after a sudden margin hike. Everyone around him sold. He almost did too. But 3 weeks later, gold was higher than before. That drop wasn't a reversal, it was a reset. And that's the deeper truth. Margin increases are not the end of a bull market. They are often a test of its strength. If the move was built only on leverage, then yes, it collapses quickly. But if the move was supported by real demand, the correction is temporary. It rebounds, and it rebounds stronger. Because the weak hands are gone. The positions built on borrowed money have been cleared. What remains is the core, unleveraged demand, commercial hedgers, long-term holders, and that's when the market stabilizes. This process repeats, cycle after cycle. Volatility builds, margin increases, leverage gets flushed, the market resets. But each time, people forget. They blame manipulation. They search for villains. They ignore structure. But markets are systems, not stories. And systems follow rules, whether participants understand them or not. For those who do, margin hikes are not events to fear. They are moments to observe. Moments that reveal the difference between speculation and conviction, between borrowed hope and funded belief, between temporary distortion and long-term direction. She once told a junior analyst, "Watch what survives the margin flush. That's the real trend." He didn't understand at first, but after 3 cycles he did. Margin hikes aren't the problem. Leverage without structure is. And the price drops that follow. They're not always warnings. Sometimes they're invitations to the few who understand them. To the ones who know that price is just part of the story. The real truth? Margin hikes don't break the market. They reveal who it really belongs to. He had always trusted the charts. They told him where silver was going. Or so he thought. When the price of silver dropped $4 in 2 trading days, he assumed demand had collapsed. Online, traders were panicking. News headlines framed it as a meltdown. Margin hikes were blamed. Sentiment flipped overnight. But something didn't add up. While the futures price was falling, the local bullion dealer had a different problem. He couldn't keep silver in stock. The shelves were nearly empty. The wait time had jumped to 3 weeks. And premiums, they had risen, not fallen. He asked the shop owner why. The response was simple. Futures are paper. This is real. And real demand hasn't slowed one bit. That's when he saw it clearly for the first time. The price on the screen wasn't the full story. She had worked in procurement for a multinational electronics manufacturer. Silver was a critical component in their products, non-negotiable. Regardless of what the market was doing, they had to buy. Every month, every quarter, every year. When futures prices dropped due to margin-driven sell-offs, they didn't celebrate. They didn't buy dips like investors. They simply continued business as usual. Because for them, silver wasn't a trade. It was a supply chain risk. This is the part of the market most speculators never see. The industrial base. The buyers who don't care about charts because their business depends on uninterrupted physical delivery. Solar panels, EVs, medical devices, water purification, data centers. Silver demand comes from all of them. And they don't get margin calls. They don't care if the COMEX drops 10% in a week. They care whether silver shows up on the loading dock or doesn't. This is the disconnect that grows during every margin event. Because when futures markets flush out leveraged positions, they create price movements divorced from real-world demand. This divergence can last days, sometimes weeks, but it always resolves the same way. The physical market reasserts itself. He had seen it happen during the 2020 chaos. Futures prices collapsed in March. But physical premiums exploded. The spread between paper and real metal widened to historic levels. Why? Because paper markets reflected fear and forced selling, while the physical market reflected scarcity and urgency. That's the reality of silver and gold. They exist in 2 parallel systems. System 1, futures contracts, leverage, margin, speed, liquidity, emotion. System 2, physical metal, warehouses, logistics, production timelines, long-term allocation. During quiet periods, these systems track closely. But when volatility strikes, especially triggered by margin hikes, they split. The price on the futures screen can fall sharply, even as physical premiums rise and delivery times stretch. That's not manipulation. It's mechanical separation. She had studied the flows. The Shanghai Exchange was showing strong premiums. COMEX inventories were declining. Large refiners were booked out for months. Bullion dealers were limiting orders. And yet, spot silver had dropped below $24. It didn't make sense, unless you understood the system. Futures markets are not price discoverers during these periods. They become volatility amplifiers. Thin liquidity combined with high leverage and automated trading creates violent price moves disconnected from actual supply and demand. Algorithms react to momentum, not fundamentals. Stop-loss orders trigger more selling. Traders liquidate because they must, not because they want to. Meanwhile, the physical market keeps ticking, quiet, unemotional, focused on fulfillment. The dealer in Dubai doesn't pause shipments because of a red candlestick. The factory in Malaysia doesn't delay orders because traders got margin calls. The central bank in Turkey doesn't cancel gold allocations due to futures volatility. These players have a different relationship with the metal. It's not a trade, it's a reserve, an input, a necessity. That's why during margin events, a dangerous illusion appears. The price has fallen, but the demand has not. And when that happens, price isn't telling the truth. It's telling a story, one shaped by leverage, not reality. He learned to track premiums instead of price. When COMEX dropped but retail premiums rose, he knew something important. The real market was not in retreat. It was just waiting for the paper dust to settle. This knowledge changed how he moved. He stopped selling dips. He stopped trusting breakdowns. Instead, he watched the disconnects. He watched inventory drain. He watched spreads between Shanghai and London. Because those were the clues that pointed to the truth. Supply tightens. Even as prices fall, premiums rise, even as charts break. Delivery delays grow, even as sentiment collapses. She once said it perfectly in a meeting with risk managers. Paper markets can lie, physical flows cannot. That's the bottom line. And that's why serious capital watches the physical side closely. They know margin events are storms, but not structural shifts. They know futures flush weak hands, but physical demand always returns. Because in the end, only one thing settles the debate. Who's still trying to get the metal when no one else is watching the price? Who controls the trend And who gets washed out every time the rules change? He had seen the cycle play out again, a sudden price spike in silver followed by a sharp drop. Margin calls, liquidations, panic selling. Then, weeks later, stability returned. And once again, prices began to rise. It was a pattern that repeated with mathematical precision. But the players? They changed every time. Some walked away shaken, others disappeared entirely. And a few came back stronger, better positioned, more prepared. What separated them? Not luck, not instinct, but alignment. She managed capital for a private fund focused on hard assets. Her strategy was simple. Only take positions that matched the structure of the vehicle. That meant no excessive leverage, no short-term trades in long-term portfolios, no treating paper like physical or vice versa. Because she understood the system, every margin event is a mirror. It reflects whether your strategy is built on structure or on speculation. Most investors fail this test. They enter futures markets expecting long-term reward, using short-term leverage. They treat volatile instruments like slow-moving reserves. They confuse belief with risk control. And when margins rise, the system reveals their weakness. He learned this lesson the hard way. He had a strong thesis. Silver was undervalued, industrial demand was rising, global inventories were tightening. But he expressed that belief through highly leveraged futures contracts. When margin requirements rose, he was forced to sell. Not because he was wrong, but because his structure didn't match his conviction. This is the central misunderstanding that margin events expose. Markets don't care about belief. They care about capital structure. If you believe in silver's long-term value, but your exposure can't survive short-term volatility, your thesis becomes irrelevant. It's not your idea that fails. It's your framework. Margin hikes force capital allocators to confront this directly. They don't offer warnings. They offer consequences. When prices rise too quickly, the system tightens. Leverage becomes expensive. Risk gets repriced. And only those with patient capital stay in position. That's the key. She once explained it to her team like this. The futures market rewards speed, agility, and precision. The physical market rewards patience, conviction, and discipline. Mix them up, and the market will punish you. The biggest mistake investors make is using the wrong tool for the wrong goal. You don't build a retirement portfolio with leveraged silver calls. You don't hedge industrial procurement with Reddit forums. You don't navigate margin volatility using emotion. Each player in the silver and gold ecosystem has a role. Miners hedge, refiners manage spreads, manufacturers secure inputs, banks provide liquidity. Speculators chase movement, allocators build over time. Confusing these roles leads to pain, and margin hikes expose misalignment more brutally than any other event. Because when volatility hits and the cost of participation rises, only properly structured capital survives. This is how markets mature. Every cycle flushes out the misaligned. Every correction strengthens the core. Those who stay learn to build smarter. They reduce leverage. They hold physical when appropriate. They position in futures only when they have the capital to withstand shocks. They stop looking for villains, and they start studying structure. Because they know something important. The system isn't rigged against them. It's just indifferent. The futures market doesn't care who wins. It only cares that obligations are met, that trades settle, that risk is contained. Understanding this unlocks clarity. Margin increases aren't attacks. They're circuit breakers, designed to prevent collapse, not to determine direction. And if you know how to respond, not react, they become powerful signals. Signals that tell you when markets are overleveraged, when weak hands are being removed, when the path is being cleared for a healthier move. He eventually stopped fearing margin hikes. He started watching them. When margin requirements rose sharply, he knew a flush was coming. He waited, watched for premiums to rise, not prices to fall. He studied physical availability, not social media panic. And when the shakeout ended, he stepped back in, unleveraged, unrushed, unbothered, because he had finally understood the system tests you before it rewards you. And only aligned capital survives the test. The final insight is this. You don't need to outsmart the market. You need to outlast it. Every margin event, every violent sell-off, every dislocation, they are filters. They remove those who don't belong. They elevate those who do. And over time, that's what determines who holds the medal when it matters most. So the next time prices spike and the margin hike headlines roll in, ask the only question that matters. Is my position built on structure or just on hope? Because if you get that answer wrong, the market won't wait to correct you. It already has a mechanism for that, and it's called a margin call.